Could BlackRock propel Bitcoin to overpower the stock market? Today we're going to be reacting to this video from Discover Crypto where Joshua Jake is going to be breaking down a lot of topics around Bitcoin and its correlation to the stock market and how it could possibly overpower it. But before we get into that, let's just take a look at the price of Bitcoin right now. It's sitting at almost 35K. Today is Sunday, so TradFi is closed and not too much has moved, but yeah, not too much there. And as we go to CoinMarketCap, not too much has moved either. And we're going to hop straight into the video. It's going to be, just a cool little reaction video. And link to this video and Discover Crypto, links in the bio, and link to Josh's channel in the bio too. Not in the bio, the description. Yeah, you guys got it. You know what I mean.
When do you see Bitcoin breaking that correlation and becoming something other than a risk asset, a true store of value?
It's this cycle. So there's two main reasons.
Do that this cycle.
What's up, everybody? Welcome to another Saturday edition of the Alpha Series here on Discover Crypto. We've got a great guest lined up. We're going to be talking with Joshua Jake. How you doing? How you feeling?
I'm doing great. Got off the plane coming to Atlanta just a few days back. Got on the plane at like $28,000 Bitcoin.
So for reference, this was made 8 days ago.
Maybe it was up 30.
And right now, today is November 5th, 2023. So 8 days before that.
Okay, but by the time I was off, 35K, market's going wild, people going, where's this money coming from? Is this retailers? Is this institutions? Is this BlackRock's fault? Is this not BlackRock's fault? And, it's just an exciting time to be in the markets for the first time in like 3 years. So I'm excited to be here.
I mean, I can echo that. A lot of people have come in this live. I mean, we have a huge amount of adoption over the last 2 years, and it kind of dwindled off. Engagement dwindled off. We see that as creators on YouTube and TikTok and Instagram where we get all those metrics. So Is there any sort of thought you have right now that you'd like to share with anybody, whether they're new in the market or they've been around for a long time? What's something that we need to consider with this new hype coming in? We got that God candle. Is there anything that we should be worried about? Is there any different sort of risk management we need to be doing? How do we not fall victim to these green candles and get ourselves in the wrong side of the position?
Yeah, great question. I would say, honestly, the first thing is realizing that we've been lied to nonstop from our financial institutions, our asset managers, just year after year after year. How many times has crypto been, had an obituary? It's been like 1,000 times at this point. There was actually just a recent article that showed CNBC and Bloomberg. So shout out to those analysts that have predicted the death of Bitcoin over I think 25 times and 35 for the other. So, moving into this new cycle, as we see hype come back and this life come back into these markets, it's the same vibes of early 2020 before we saw that rally into 2021. Don't chase the green candlesticks, right? Venture capitalists, asset managers, banks, they don't chase green candlesticks, right? They're buying and accumulating year after year when we're in a bear market. So if you're brand new to this industry, you just see a big green candlestick and you're like, man, I should buy before it goes up further. Just take a breath, sit back and just, let it find support. Just give it a moment and truly just understand what the asset you are buying actually is, how it functions, what the utility is before you make that investment decision.
I mean, I couldn't agree with that anymore. We talk about other people like Michael Saylor. He's become I don't want to call him the mascot or the spokesman of the Bitcoin space, but he is case in point, just taking it to the shoulder, taking it to the face, taking it to the back when he's just been DCAing nonstop. Some people call him
the DCA warrior, Michael Saylor.
Dumb in some areas where he's buying near a top, but then you see he's also buying near a bottom. It's that, time-tested.
I love the people who call Michael Saylor dumb on Twitter. Like, this dude's not worth billions of dollars. And I think he's up almost $1 billion on his Bitcoin position. So, in a long enough time frame, I think it's going to be the correct trade.
Strategy of buying because he sees value long term. So how does one gain confidence when they're seeing the market swing about and, to have that confidence to be a consistent buyer? I mean, we were talking earlier, you mentioned that one of your main strategies, barring any other trading, your main strategy is DCA. So how does somebody, whether they're trading right now, they just got in, or they've been around for a long time, why should somebody DCA? Why do you use that as a strategy, and how can we implement that in all of our own portfolios to have more consistency and longevity in this market?
Yeah, so there's two main reasons. The first one is just time in the market always beats time in the market. I think that's a historical model. A lot of people that have tracked the S&P and just traditionally traded, they follow that metric, right? You don't want to be trying to time the bottom, time the top, just consistently average in. The second point of that,
yeah, that's one thing. You're never going to time the bottom or time the top. It's not going to happen. It's not. Okay?
is going to be just watch your local news media right now. Watch CNBC, watch Fox News, watch CNN. And not in the sense that you're going to take and absorb information from there, but realize that every economist in the world right now that has the PhDs, has the master's degrees, has 14 books, has a $100 million hedge fund or a $100 billion hedge fund, they're all fighting. They cannot compromise. They cannot come to agreement, right? Whether it's the war in the Middle East or it's the war in Ukraine or it's developments in the Indo-Pacific. People don't understand and can't figure out where we're heading in the future because we just printed.
So I'm a big DCA guy, and I'm going to quickly intervene and tell you guys why I DCA. The reason why I DCA is because day trading and all that stuff is bullshit, dude. It's complete bullshit. And I don't care what anyone says. 99% of day traders lose. It's the top 1% that are actually profitable long term. So you're going to be competing against dudes. If you're like one of these guys who's like, oh, I think I'm going to day trade as a side job or a side hustle, you're going to end up losing money. You're competing against the top 1% of day traders are full time, clocking at 9:30 when the bell rings, and they're there. They're doing all the technical analysis and shit. Even though some of those people who try to go full time to day trading end up losing too, because it's the top 1%. You're literally better off going to a casino than day trading. It's statistically, that's an objective truth about day trading. And that's why I think most people should DCA, not financial advice. That's just why I DCA personally, because I'm not fucking day trading.
To $9 trillion in the last 3 years. So this is like the first time I think you've seen a lot of economists not say, hey, take a pause back, let's focus on risk off assets, or let's focus on risk on assets. It's more or less, man, when is the Fed's going to pivot? Are they going to pivot too quickly? Is this going to break the wage versus wealth gap in America? Are we screwed? As a 26-year-old, am I ever going to be able to buy a home again in my life? Right? These are those questions that are starting to ramp up. So off that second topic, how do I position myself? I don't care necessarily what someone that's 70 or 80 plus years old is wondering about what's going on in the markets. You just brought up Michael Saylor. He's either going to be the next generation Warren Buffett because he makes the best trade in his life off Bitcoin, or he's going to fail miserably. Now, I like to lean.
You know what's funny? If you look back at MicroStrategy during the dot-com bubble, it was literally the biggest like pump and dump stock. It's kind of hilarious if you look at it, because in the early 2000s, when MicroStrategy stock goes up and then crashes down, and then it comes to... And then it's like kind of hanging out the lows, and then Michael Saylor gets into Bitcoin, and we saw this past bull run, it goes up, and then it crashes, but now it's going back up again. So, yeah, we're going to see. It's either going to be the greatest trade ever or the biggest flop ever. And I respect it. Man's going balls deep.
Lean towards the positive side of that because I am very bullish on Bitcoin. But that's my outlook. You know, when I see all these economists and these people that have been managing these hedge funds and asset management firms for, 2, 3, 4 decades at now, you know, when they tell me that I'm wrong, that crypto is a bad investment, and I see the adoption on the back end, all I go is show them the chart of the wage versus prosperity gap in America. Go to 1971, what WTF, I won't say the word, but WTF.
That is very base what Josh just said right there, because people, unlike back in the day, people are now basically kind of forced to take on and invest. Everyone nowadays who's younger is basically forced to become a macroeconomist, a fake, macro guru, and an investor, because with the wage gap continuing to go like this, as they continue to do more QE, people are forced to, invest in risk on assets. And that's the truth. And guess what? Crypto is a risk on asset. So naturally, because the wage gap keeps expanding, because they keep printing so much money, people are being forced to gamble and basically invest in stuff like crypto. It's a natural, that's what happens. So you can't just put your fucking money in a 401k and then expect it to get, gains and buy a house and all this shit. You got to be putting your money in crypto, because that's the way it works nowadays. I don't think I articulated as well as I should have. I'm very, very tired making this video, if you couldn't tell by now, but yeah.
Happened in 1971.com, and you're going to look at the wage versus prosperity gap. Our politicians, our lobbyists, our economists, they've been wrong for 50 years. This inflation is not stopping, and it's not going to stop. So how I hedge myself is I follow something pretty similar to the 50-25-25 rule. What that rule is 50% of, this is my personal opinion, not FA. We know the rules here. Is ultimately going to be into those large caps, Bitcoin, ETH, some people like Matic, some people like XRP, whatever your blue chips are. Personally, that's Bitcoin and ETH. The next 25% is going to be your large caps, mid caps. You want to diversify, and that last 25% is going to be the VC strategy, right? You need to think like a venture capitalist coming into this space. This is the jungle. This is Wall Street 2.0. This is no different than Silicon Valley. This is no different than the dot-com bubble. There's VCs coming in here like sharks, wrapping software as a services in a product or a utility token, and just pumping and dumping a same product that's a copy and paste of the previous. And so for that reason...
That's the truth. A lot of these VCs are not in it for the long term. They are in there to get a return. So keep that in mind.
I treat it like just VCs. I want to diversify and invest into quite a few, understanding that, yes, 6 to 7 of them are going to go to zero, 3 to 4 of them are going to break even, and 1 is going to hit that moon back.
So I'm going to pause you there just for a moment, just to clarify. 50% Bitcoin and Ethereum, or Bitcoin or Ethereum. Another 25%, those other blue chips. We're talking, something probably in the top 20, I would guess, right?
Yeah, top 20,
and then
30. Yeah.
The last 25%, you said VC, so it's a higher risk, the lower market cap, most likely. Are you putting all of that 25% into one, or are you breaking up it into 5, 10, 15? I suppose that might be determined on how large the capital pool is that you're pulling from.
Definitely breaking up. Yeah, the moment you're taking more than even 5% of your overall 100%, right? So if we have 100% of that portfolio, you shouldn't be allocating 25% of that to meme coins, right? Things that have no utility, or products that have no fundamental value at all, like Hex, right? Yes, I'm going to take a shot right there. You want to spray and pray on that, because at the end of the day, it doesn't matter if necessarily these products have good utility or not. Look at Solana. It's broken down more than an ice cream machine for McDonald's. You've heard the memes, right? It's closed on Sundays like Chick-fil-A. So, from that aspect, it's going to come to that marketing. And so again, no utility, but they're going to pump. So that's where you just want to diversify into, honestly, like 20, 30 cryptos. We're talking about you're putting $100, $200 into a bunch of them, understanding, yes, it might go to zero, but also this might be the next pulp.
I'm going to give my personal opinion. I do agree with Josh. If you do go for the low altcoins, if you're playing that game, you can you can get like 20 coins, but I personally like to keep under 10. Now, in the bull market, I'm going to end up probably like chucking maybe like $100 at some shit coin and seeing if it runs, but right now, I'm sticking to, not that many. I'm personally thinking, hey, just in my personal opinion and what I do for myself, it's like if I had 20, 30 coins, I'm not going to be able to keep up with those 20, 30 coins. I'm with what I got going on right now, I'm able to check on the price and I'm able to stay on top of it. I think it's low key. I don't know. If you can handle looking at 20, 30 coins a day, that's fine. But for me personally, I like to keep it under, and that's just the way I roll. But do whatever floats your boat.
Polygon Matic, or this might be the next Decentraland Mana, or whatever it is that we saw pump in 2021.
So you brought up a great point earlier, and I want to get your perspective on this. This is, I think, a very important consideration with Bitcoin, because Bitcoin, in a lot of ways, drives the crypto ecosystem. So what happens with this narrative, I have to ask you, with risk on, risk off. Currently, it's still considered a risk off sort of asset in terms of you're going to typically want to look to Bitcoin when risk comes back in the market, right? So because it's high risk. So is it risk on? Is it risk off? This debate about Bitcoin still being whether or not it's digital gold, it's going to be an inflation hedge. I think in the long term it will. But I have to ask, what's your perspective on when Bitcoin may...
And let me comment real quick. Bitcoin is not a CPI hedge. It's a hedge against a whole monetary supply of, dollars and everything. It's not a hedge against the CPI, which a lot of people get confused because they're like, oh, well, inflation came and then Bitcoin, went down. It's like, first of all, it's extremely volatile. Second of all, it's a hedge basically against the whole monetary system and the inflation of the, amount of dollars that are in the ecosystem. So, yeah.
Flip out of that risk narrative where it's truly a commodity, where it truly not only trades in its own sort of sector, but also counter to, for instance, right now we see the markets maybe on the cusp of breaking down, especially after the Fed pivots. Is Bitcoin ready to have a true and like a sustained and continual breaking of correlation with traditional assets? When do you see Bitcoin breaking that correlation and becoming something other than a risk asset, a true store of value?
It's this cycle. You get a lot of talks of de-dollarization. There's lots of talks of BRICS, China, Russia, Brazil, India, South America, all coming together and building a system that's an alternative to our current currency in the United States. Now, for that reason, that's because of all the money printing we've been printing the last few years, and inevitably we've been indebting third world countries, second world countries with World Bank loans. And what happens when the United States raises their interest rates and force us to not only print more money ourselves to pay back our own interest rates, because next year we're going to be paying back $1.25 trillion annually just in debts that we owe based off our own interest. It's ridiculous. But people don't realize the impact that has on third world countries and second world countries. These countries are indebted to the United States. They have U.S. debts, U.S. treasuries, right? So when they're holding on to these assets, it's going to force them to print more of their own money just to pay back off the U.S. loans that they owe, right? So, it causes hyperinflation. It destabilizes a lot of countries. And for this reason, you're seeing a lot of second world countries, third world countries now come into play and starting to do things like in the Middle East. You had, I believe it's pronounced Oman. I could be pronouncing that Middle Eastern country wrong. But this is right on the border of Saudi Arabia. This is in that oil basin area. They're investing $1.1 billion into converting wasted natural gas and methane emissions into a net value with Bitcoin miners. What do I mean by that? Well, this is where the world's greatest commodity comes into play. You see, most of the energy that's created in our world through our fossil fuels. So let's get this out. Greta Thunberg was wrong. Okay. We need nuclear. We do need to go towards renewables, but we rely on fossil fuels. That's not going to go away. And the infrastructure that's been built out in the United States and globally, it would take us years.
Yep. We need fossil fuels in order to keep this world running. It's a hard truth.
If not decades, to replace the equipment and infrastructure to support new energy. So with that understanding, we have all of this energy being created, and you have, and I'm sure you guys have seen it, but oil fields where they're just flaring gas emissions and burning off all these oil emissions into our atmosphere.
Pure waste.
Pure waste.
Why not harness it?
Exactly. And so we're now seeing companies like Crusoe Energy, Clean Spark, and a lot of companies come together through Exxon, ConocoPhillips, even Gazprom, which is going to be one of the largest oil providers in the world out of Russia. They're all converting a lot of that wasted energy into a net value with Bitcoin, and that can be done anywhere. So for that reason, I think this next cycle, this is the time where we have the spot ETFs. We watch BlackRock, JP Morgan, Bank of America, Wells Fargo, everybody manipulate our markets for the last 5 years. They're calling it a money laundering index. They're saying it's a scam. They're saying it's going to go to zero. Meanwhile, the whole time they're investing on the back end and getting ready to develop what I believe is going to be the next biggest financial product ever, which is a Bitcoin spot ETF.
Joshua, it's been great talking with you. Where can everybody find you?
And I believe that too. I think the BlackRock spot Bitcoin ETF, when that shit gets approved, it's over. We are going to the fucking moon. Not financial advice. That's just my opinion. Anyway, guys, that was a great video. Make sure to go check out Discover Crypto on YouTube. Go check out Joshua Jake's channel. Links are in the description. And yeah, guys, I'm hoping tomorrow we have a lot of more news in the market and stuff. But if you enjoyed this video, you enjoyed this reaction, hanging out with me, make sure to go follow me on Twitter. My link is going to be description to my Twitter. We're turning up there. And yeah, guys, thank you for watching.